Good afternoon, everyone, and thanks for joining us here today. I'm Carolina Albernas, Director of Business Development Operations at the Brazil-Canada Chamber of Commerce. Thanks for joining us here today. So just as an information, after the presentation, we will have a Q&A session. So if you have any questions during the presentation, please type them on the Q&A box and we'll go through them afterwards. First, for those who are not familiar with the BCCC, for 47 years, we have been building relationships between Brazil and Canada, strengthening the bilateral relationship in investment, trade, best practices, and mutual growth and prosperity. Our relationships are private and public, featuring the managing directors and decision makers of small companies, large companies, and very large companies and institutions. Our volunteer board of directors has expertise and knowledge and connections that can only be found by being active players in the Brazil-Canada market. We're a membership-based association that support its members through advocacy and government access, qualified information and insights, and connectivity. So just as an example of our activity, since 2018, we have organized more than 50 events in 10 different sectors with over 1,500 attendees, and we're moving everything online at least for the next few months. We've established over 10 new partnerships and supported many trade missions with a total of 70 companies looking either to establish themselves in Brazil or Canada or connect with clients and suppliers. So if you want to learn a little bit more about the BCCC, please connect with me. About our webinar today, corporations are facing challenges on a scale that is stretching its leaders and boards. However, as we're now starting to see government easing some of the lockdown restrictions, the focus will inevitably move to the restoration and repositioning of businesses to be financially and strategically viable. Some businesses will be in financial distress or be in danger of going under as a consequence of reduced demand during the pandemic. And some sectors might require ongoing financial and or government support. So our workforces are likely to challenge some of the notions of having to be in the office, given that they will be having been working remotely for an extended period of time. In face of such uncertainty, business leaders need a directional compass, a toolkit that will help them navigate through this unprecedented crisis. I'm pleased to introduce our panel today. Although the bulk of their experience has been in financial service sector, today they're going to share with us their experience of dealing with systematically important financial institutions during the 2008 crisis, what learnings can be applied, and what software applications they have that can help businesses to develop capabilities. Without further ado, please welcome the BankingBook Analytics experts, Sohail Farouk, Chief Executive Officer, David Gong, Chief Operational Officer, and our moderator today, Paula Saad, Chief Commercial Officer, and also our past president. So thank you.
Thank you, Carolina. It's a great pleasure to be presenting this webinar. This is an opportunity to consider the lessons from severe disruptions and market dislocations can be applied for COVID-19. I would like to begin with Sohail by asking first if you could briefly introduce the firm and then share with us how BBA can assist executives and business leaders in transitions from the crisis to the new normal.
Thank you so much, Paula. Thank you, Carolina. It's a great pleasure to be in attendance today. And just by way of introduction, we signed up for BCC a few months ago, and we are extremely grateful for the kind of exposure and the learning that our organization has been engaged in. So thank you all who are at BCC for such a great job. Before I begin, I'd like to briefly introduce myself. My name is Sohail Farouk. I'm the CEO of BankingBook Analytics, a firm that we founded in 2018. But at the back of it, there has been a lot of work which has gone into in terms of the intellectual capital that we have, the content expertise, and the domain expertise that we bring, and how we are developing technology to assist businesses far and wide, not just in financial services. Personally, I have over 20 years of experience, which started with 7 years at large Canadian financial institutions, about 12 to 13 years as management consultant and technology executive, and then the remaining period for BankingBook Analytics. So let's just, thanks so much, Carolina. Let's just move on to the next slide. Very briefly, given that we are having a late start, the key purpose of our organization is to develop an analytics-driven organization. We are a data-driven solutions company which provides technology solutions and analytics advisory. And our areas of expertise and the impact cover two broad themes. The first is capital and liquidity preservation. The second is profitability enhancement. And for that, we've developed a technology platform which includes over roughly 7 applications that allow our client organizations to focus on these two broader themes. So on the next slide, please. Perfect. So these are the 7 applications that we've developed. First and foremost is Scenario Frontier, something which is of great interest as of today, which looks at a range of scenarios and identifies the threats and opportunities for the organizations and helps them mobilize resources to understand the risks and navigate through the crisis or disruptive environment that they find themselves in. And the second one is for the capitalization, risk-based capitalization. And then we've got predictive consumer behavior applications, which include mortgage retainer pricing at retail and commercial level, which also covers the transfer pricing. Finally, on the profitability analytics, we look at be it a virtual or a brick and mortar point of sale. We look at the brandscape from an efficiency and profitability perspective, and also the AI-based or model-based analytics, which looks at the predictive power of each model that the organizations are using. Next slide, please. So we have a spectrum of consulting services, which ranges anywhere from regulatory compliance to cyber risk management. We've recently concluded a study with Global Risk Institute on cyber risk quantification. If you'd like to have more information, please feel free to visit our website. Okay, so without further ado, let's jump into the webinar. So as Carolina and Paola have succinctly explained, that right now, on the next slide, please, that right now business leaders find themselves moving from, next slide, please, moving from a crisis situation where it was a bit of a firefight to to a period where they have to basically go back and take a stock of their businesses, identify what sort of financial resources they have available, and how they can reorganize and mobilize their businesses to actually engage with their clients in the post-COVID-19 era. So before we set on to the framework that we are going to present, we would just like to set the stage up. So global studies by economists have identified that we are looking at a fiscal or a calendar year GDP drop of roughly 4%. And if we were to extrapolate that learning, we have the projected GDP growth rate for the province of Ontario here in Canada. And as you can see, that the forecast is about 2.8% decline, which is a very steep decline and has not been witnessed over the past several decades, which also includes the 2008 crisis. So as you may notice, that we are also forecasting a roughly 4.5% decline here in Ontario. So what are the implications of such a decline? Let's have a look at the next slide, please. So as you can notice that from an organizational perspective, what the business leaders need to know is how is this going to have an impact, and what kind of recovery scenarios they should be looking at. So the scenarios for recovery have 3 or 4 permutations, which the economists have identified. The first and foremost is the V-shape, which basically looks at a decline, a steep decline, and a very quick, robust recovery. The time period or the time frame for this recovery is being estimated around 12 to 18 months. The second is essentially a U shape, which implies a sharp drop and a gradual recovery. And the third is essentially a W shape, which basically reflects that there is a likely disruption, which could be an outcome as a result of inflation or some other correlated crisis which can emerge over the next period of time. And there could be many other permutations. So from a business leader's perspective or from a decision maker's perspective, this is, of course, a very, very challenging situation. They not only have to deal with the crisis, but they also have to reorganize their business, be it a large business or a small business, and prepare themselves for disruption. So this disruption could emerge from lack of motivation at the workforce. It could emerge from a dislocation of a supply chain, or it could also emerge from a stressed financial situation. So for them, it becomes extremely important that they re-strategize their business, look at the emerging environment and identify how they can go back and complete the mandate for their business. On the next slide, please. Right. So the key questions that emerge from leadership perspective is, what happens if things go wrong? What would be the quantum of the loss? Will we be able to survive? And essentially how bad things can get, and what should be done in order to mitigate the potential losses. So all these questions in all their manifestations have some impact which can lead to quantification of different variables. So if you're a not-for-profit organization, or if you, such as university, you have to look at student enrollments. What impact would it have on the enrollment of students? If you're a goods or a services company, you need to be able to look at what would be the impact on the demand of the goods that we are producing. What would be the impact on the services that we are producing? Similarly, if you're a financial institution, which is engaged in consumer lending, they need to be able to look at what would be the impact on the defaults of their loan portfolios, and so on and so forth. So these sort of impact-related situations are really an outcome of macroeconomic variables and how and to what extent they explain the variability in demand of the services, in demand of the goods, or the defaults from a consumer lending perspective. So that's really the kind of scenario-related development that we need to look at and determine that whether or not the answers to our questions are provided by some macroeconomic studies and learning how they would have an impact on our range of activities. Next slide, please. So before we actually go back and have re-examine the role that scenario planning can play in identifying the risks that the organizations are facing and how best to mitigate those risks, let's just have a quick glance on how this pandemic has played out so far. So looking at the pandemic, before the pandemic, disruption was considered perhaps not a regular occurrence or not an integral part of strategic planning. Strategic planning was somewhat insular. You know, we were certain that the GDP would grow by a certain percentage points. We were certain that we would be able to identify a target growth rate and be able to achieve that growth rate within a certain range of that growth. Even the preferred range would be exceedance of the growth rate targets. But such insular strategy, strategic approach to business planning, of course, gets challenged by disruption, and disruption at a scale which has been unprecedented from the perspective of COVID-19 makes us rethink that whether or not we want to actually use scenario planning or insular strategic planning. So before the pandemic, real estate growth was across all spectrums, but now that might change. We are looking at some sectors which would emerge as preferred strategic investment sectors, such as healthcare, logistical assets, data centers, and low density occupancies. Before the pandemic, risk was regarded as a business hinderer. So from a risk assessment perspective or compliance perspective, the thoughts were that this is a cost center with limited or low value add to the business. And then, looking at the liquidity costs or transfer pricing mechanism that existed between various organizational divisions, the transfer pricing mechanism was not really playing its adequate role. The pricing was based primarily on the competitive pricing as opposed to the transfer pricing, and how and why the price that should be based off of a management accounting perspective was considered as a bit of a less important. Now, moving to the after pandemic side of the slide, the key thing is that we need to look at the structure of the business in terms of increasing the resilience of not just COVID-19 disruption, but future disruption. So in other words, disruption management becomes an extremely important element of ongoing growth and strategic positioning of the business. The second piece here is maximizing the performance of the core business. How can we actually maximize the performance? What is how we can overcome the cash shortages, address the supply chain disruption, and so forth. And of course, the most important is, do we need to refresh our strategy? Do we need to look at our pricing models? How do we motivate our workforce? So these are all some very, very important emerging variables, which are not just outside in, such as the macroeconomic variable, but also inside out. So these are the internal variables that are going to play out and have an impact on how the business is repositioned after the pandemic to be able to deliver its core services. Next slide, please. Okay, so this brings us to scenario building and application in forecasting the financials. Next slide, please. So typically, a lot of the learnings from crisis management emerged as a result of the 2008 financial crisis. In several of the case studies, as well as taking the stock of how the 2008 financial crisis emerged, we noticed that Federal Reserve in the U.S. Made for a certain cohort of financial institutions, it made it mandatory for them to run stress tests. And stress tests were based on three important assumptions. The first one was the base case growth of macroeconomy, which not just featured the U.S. economy, but the global economy, with special emphasis on the EU economy. The second was the severe or the severity of which would challenge the growth or the base case notions of growth for the macroeconomy. And the third was adversely severe, which looked at essentially a black swan event. What if something to the extent of wiping out the entire capital were to occur, and how we are going to develop early warning signals, we are going to identify the risk hotspots and be able to mitigate those risks. So that with that as a background, the role of scenario planning dates back not just 2008, but even goes a few years before that, where key macroeconomic drivers were looked at. And the reason behind looking at the macroeconomic drivers was that to what extent these macroeconomic drivers forecast or explain the variability of our business. So for example, if we are looking at demand for goods and services, to what extent these macroeconomic drivers can forecast the demand for goods and services? To what extent they can forecast the student enrollment at universities? To what extent they can forecast the defaults that financial institutions face in their credit portfolios? So as a result of this study, we actually ran several multiple or multi-factor regressions, and we found out that the range of explainability of these macroeconomic variables is anywhere from 75% to 80% in different situations. But the challenge here is to identify the most relevant or the highly correlated macroeconomic variables from every organization's perspective. These would vary because of the nature of their business. So the next step would be, once you've identified these risk drivers, the next step would be really look at the long list of scenarios. Now you can imagine each scenario being a headline for a story, such as real estate crash, disorderly dollar crash, sovereign default, regional unrest, and so forth. And then using a study or a workshop setting, you can pilot these scenarios, bring in internal experts to be able to create a short list of these scenarios, and then map them against various recovery scenarios that we've talked about, which could include V, U, W, or L-shaped recoveries. Now, once these recovery scenarios are basically using an econometric framework, are mapped against these the portfolio, you can then determine a scenario-based impact on your financials, which would include the impact on balance sheet, income statement, capital, impact on liquidity, and finally create an internal reporting framework, right? So let's move on to the next slide to be able to actually look at some of the scenarios that we think are of relevance in today's situation. So of course, you know, COVID-19 is a trigger point, and what is it that it can lead to? So here what we've done is we've looked at some domestic scenarios and we've looked at some globally focused scenarios. And out of the domestic scenarios, we've mapped them around a framework which basically has the likely severity and the likelihood or the frequency of this scenario. And again, this is of course normative exercise. You know, this can be done within with a group of people who are experts in a workshop setting and can be piloted. And of course these are all illustrative, and it doesn't necessarily mean that, you know, this is the consensus opinion that we have at our firm. So with that being said, at the bottom of this slide, you can see that we've identified, you know, just in a very qualitative way, what would be the likelihood and how would it have an impact on sort of the organizational areas of strength, or the strongholds, which we would call. So for example, from a financial institution's perspective, you know, a natural calamity can lead to credit losses, it can lead to the slowdown in the volumes, liquidity crisis can have an impact on the margins, on the asset valuations, and so forth. So extrapolating these scenarios into our portfolio, we can really come up with the likely impact. And just remember that we are not doing any mathematical or any econometric exercise here. We are basically using our expert judgment to come up with the potential likelihood of the severity and the likelihood, as well as the impact on the organization. Right. Next slide, please. So on the next slide, we are basically taking this one step further, and we're looking at how a selected scenario can have an impact, which we are calling a transmission mechanism for each scenario on the organization. The first and foremost is that it attacks the vulnerability. You know, if you look at from a frequency perspective, it attacks the vulnerability of the organization. So a good example could be that in crisis situation, cyber attacks, they intensify, and the hackers are looking at large attack surfaces where they would find some vulnerability, and they would try to sort of, you know, use the ransomware or some other sort of adversarial software to sabotage the system, right? Similarly, from a severity perspective, you know, these are essentially the primary and the secondary losses, and they can be divided into not just the direct losses that we just talked about, which were, let's say, in the case of a liquidity crisis, drop in valuations or in the margins. They can also have an impact from a secondary perspective, which we're calling a knock-on effect. So that can lead to a knock-on effect. So for example, if the valuations are dropping, the margins are dropping, the next thing is the recourse to cash and the survivability of organization can get potentially challenged. And imagine that if that gets coupled with a large default by a big client, you know, that can essentially wipe out the entire organization's capital. So of course, this all has to be looked at from a perspective of the scenario transformation mechanism, not just in isolation, but also create correlations and knock-on effects and how they're going to have an impact. The next slide, please. Perfect. So as we talked about the scenarios, and we're just going to spend a bit more time on how to design a scenario. We talked a little bit about the risk drivers from a macroeconomic perspective, and how these risk drivers can explain the variability of the core product, variability in the demand of the core product. We talked about the demand for goods and services or student enrollments. But if you were to actually use these macroeconomic scenarios and then map them out to a headline story, which could potentially be a case study from the perspective of real estate crash, then the first point would be that what were the historical relationships that existed between the organization and what impact did it have in the past sort of real estate crash? Are those relationships going to get dislocated again, or there's going to be even an increased severity in terms of dislocation of those relationships? So we're looking at, such as real estate crash, and what impact would it have on different businesses, and depends, where the business is located from its domino effect in the value chain. Finally, we can have an expert overlay. Of course, this is all a very qualitative and normative exercise. An expert judgment can be brought in where the experts can identify, as we said, not just the direct impact, but the knock-on effect. And then, we can use these risk drivers, which are on the left of the slide, and we can parameterize them based on expert judgment that, how the forecast for, say, fiscal year or calendar year would map itself out with regards to these various factors which have high correlation and higher variability explanatory power for our business, right? And the next slide, please. So what we did here is that we looked at some of the risk drivers. We identified, from their relevance from Ontario's perspective. And let's just imagine that, we are hypothetically conducting this exercise for a credit lending institution. Now, from the perspective of credit lending institution, we singled out, or we shortlisted these 5 risk drivers, which essentially included the GDP growth rate, and the interest rate, the unemployment, and inflation. And finally, the housing start. So, and then using the base case that we presented at the beginning of this conversation, we also sort of mapped out what we would call the adverse case or stress case. So in the stress case, as you can see, we're looking at a V-shaped recovery, or this could very well be a W recovery, and again, this needs to play itself out. But from a business leader's perspective, from a decision maker's perspective, this information is extremely valuable because it allows them to position their business to manage the downside risk and to identify the kind of resources and the action plan that they would need to be able to overcome such dislocations and stresses in the macroeconomy, and also the risk drivers that we've identified and how they would play out on their financials. Next slide, please. Great. So in a nutshell, business leaders need to use scenario planning as a directional compass, which allows them to have a consolidated, have a top of the house view, which is not insular, which is not based on silos, and which is not designed to keep the information very, very centralized. And this allows them to manage disruptions more adequately and to be able to mobilize resources to manage the downside risk. Now, as we said, that there could be several permutations from a base case perspective, which includes an L-shaped, W, V-shaped recoveries. You can have these permutations and lay them out. So here we've basically just, for the sake of brevity, we've identified 3 permutations, which is base case, the stressed case, and the adverse case. Now, in the base case, what is important here is that business planning is not done internally, but it is also viewed externally. And now, with scenarios being part of the equation, financial statements can be designed and can be calibrated to macroeconomic scenarios. So such that if there is a movement, be it positive or negative, the financial statements can also reflect that movement, right? And you can create different relationships between the dependent and the independent variables and run those using certain software algorithms, or you can even develop internally. The second one is, of course, the stressed macroeconomic scenario. So this is really to prevent the downside. Now, the first one is, of course, from a calibration perspective, you're mapping your performance of the organization relative to the macroeconomic situation. The second is from management of downside risk. Here, you're not just looking at the upside of the business, but you're also looking at the downside. And in the downside scenario, you're trying to create loss absorbency capacity for your business. And in the adverse case, the objective here is to be able to develop mitigation plans against a black swan event. Now, of course, if anyone were to consider COVID-19 and its impact as a black swan, so we are right now really looking at an adverse stress case, and we are basically looking at how it's going to play out from that perspective. Now, the key things here are develop an early warning signals, develop a list of early warning signals. So for example, how the ratings would deteriorate, how the credit bureau scores would drop as a result of defaults going up, and similarly how it depends where you are in the value chain from an economic perspective, but you can really look at how your business is going to get impacted as a result of black swan event. And of course, you also need to start looking at risk hotspots and how they're going to change their position, and this needs to be done on a more frequent basis. So not just annual or 6 months, but rather on a quarterly or more so on a monthly basis until we are out of this crisis. Next one, please. Perfect. Now I'll pass it on to my colleague, David Gong, to walk us through the rest of the slide. Thank you so much.
Thanks, Sahel. Next slide, please. Now, as we can see, businesses can utilize the outcome from scenario-based planning to facilitate the creation of short-term strategies made in response to an unexpected stress event or crisis. Now, in order to succeed post-crisis, we have to have considerations, and they need to be given on how we protect the revenue base, for example, in times of crises. How can we identify opportunities for cross-selling in these times? Can we find ways to launch new fee products? How much can we protect existing agreements and commitments and increase collection-related activities on that end? For the areas of cost optimization, maybe we have to provide a better value proposition to existing and new colleagues. For example, increasing the balance of home and office working, or reducing unnecessary travel and commuting time. I mean, you're seeing that right now, especially in North America, where we have lots of intellectual capital professionals just doing work from home, and then having a theme of possibly moving towards that on a more permanent basis after we get through COVID-19. How can we leverage the learnings of remote working and other countermeasures to potentially increase efficiency and lower costs? How do we structure our businesses or our teams to increase the resilience to future disruptions? Be those disruptions being pandemic or other market, or maybe possibly even other systematic events. From a balance sheet management perspective, we have certain actions that we can undertake. We can perform credit reviews by cutting customer limits, restricting lending policy, and reviewing the loan portfolio. We can boost liquidity by selling or collateralizing securities, perhaps engaging in transactions to lower the concentration of liquid assets, finding which of our assets are unencumbered and securing them, as well as limiting drawdowns and withdrawals to organizations that are subject to those. Next slide, please. So the approach to forming a sensible and defendable management action plan being detailed in this slide follows a very logical flow of ideas. How much capital do we need given the state of outcomes that we think we'll face? That's what we consider as the base capital plan. It assumes a particular state of economy over the planning period. Given unforeseen events in the economy, how will our base case capital plan fare? Do we have enough capital to survive the worst events? This must be tested thoroughly, and we must go through a multitude of scenarios to be able to properly quantify the answers to those questions. Now, from a cash flow management side, how can we be proactive to mitigate the risk of these stressed events? What would be the costs associated with that mitigation? What contingency plans can we put in place, and what assumptions do these contingency plans make? For example, we could have a plan A that covers us in a financial emergency, but be possibly or completely irrelevant in the case of a large global shift in geopolitics, for example. How can we be sure that the contingency plans we make will be available in all scenarios? Finally, to answer all of that, we have to create a holistic capital plan, which incorporates mitigating actions and seeks to embed capital management in core processes. This generally translates into a base capital requirement, plus a buffer that represents the reserves, in addition to the cost of mitigating actions. Now, if an organization has shown the discipline and has a history of putting into place proactive plans to mitigate, then that could be a justification to lower the capital cost associated with those actions. Next slide, please. Let's take a look at an example of a management action plan template. This is how we would want to present a plan to the executive committee in order to provide them with an idea of what we want to do, what we want to accomplish, and what risks and threats we face. And we start off by looking at the scenario specifically. In this case, it's a real estate crash. We look at the background of that. So why could this scenario occur? Or what products or services would be impacted? How likely is this scenario going to occur? How well are we prepared for this? And what extra steps would we take to mitigate the impact of this? We then look at the relative products, processes, and locations that would be affected in the organization in question. We also look at the outputs of the model that quantify the losses in such a scenario. Now, all this information and all this background will lead us to be able to create an appropriate end-to-end response and mitigation plan. We can implement the processes and best practices pre-scenario in order to be as prepared as possible to weather any storms. For example, we can increase training for our people. We can make sure that our processes are timely, they're monitored, and they take into account redundancies that may be needed in the event of a large stress scenario. And then when the unfortunate happens, we have a quick and concise plan of action to implement immediately. We can, for example, tighten the lending on our residential or commercial real estate to prevent losses due to credit downturns in the event of a large stress scenario. We then describe the recovery estimates in the face of that scenario to give us an idea of what capital we can work with post-stress and begin the path forward. Now, when considering the potential impact of disruption, we have to ask certain questions. Are we taking into account more wide-ranging or systemic impacts? For example, how could the future of our industry be affected by the disruption of a virus outbreak such as COVID-19 that we're facing now? Are our business continuity plans and crisis management plans, are they designed to incorporate the scenarios that have the severity of the impact that we have observed from COVID-19? And are our plans tested against these severe outcomes, and are the gaps and shortcomings identified before these plans have to be put in practice? Next slide, please. BBA has developed an application to assist with this titled Scenario Frontier. Now, this is a fully featured stress testing and application that is made to take in user-defined scenarios and arrive at a clear and detailed picture of the future that the company can then use to make informed decisions. We observed that stress testing in the industry is shifting from set-piece compliance exercises to meet more broad-based expectations of boards, investors, and markets. Accounting standards such as IFRS 9 and CECL compound the challenge and companies can no longer afford the time-consuming, laborious processes and rudimentary tool support, often found in the form of numerous manual spreadsheets. We are able to customize Scenario Frontier to match the needs of our various users. For example, basic practice organizations who just need to demonstrate to regulators that they are adequately managing the volatility risk of capital can be well served by a multi-year, scenario-based, point-in-time parametric stress testing to determine their loss absorbency buffer. This has the benefit of providing point-in-time modeling in addition to management of procyclicality and systemic risks. This also ensures that the stress testing an organization undergoes is ICAP compliant. For our larger standard practice organizations that desire strategic scenario planning for business-focused and official regulatory exercises, Scenario Frontier is able to deliver flexible creation and quick impact simulations of macroeconomic scenarios. Each scenario comes with 3 permutations that were discussed earlier: the base, the adverse, and the severely adverse or reverse stress cases. This provides a bottom-up coverage of material risks, such as credit, concentration, market, operational, ALM or asset liability management, liquidity, business, and pension fund risks. This approach has the benefit of Scenario Frontier for basic practice organizations, plus, in addition to those that were mentioned prior, DFAS compliance and having a multi-year buffer assignment mapped to each material risk. This enables executive level management of capital and dividends with the confidence that the sources and uses of capital are well managed. For our advanced organizations that require a combination of enterprise-wide stress testing with IFRS 9 and/or CECL, as well as organizations that need a stress testing challenger model, Scenario Frontier can additionally simulate up to 3 years of company performance and financial statements associated with various outcomes. It can provide strong workflow management, which allow for senior management insights stemming from a bespoke dashboard created using leading analytics. A risk appetite dashboard and buffer allocation based on risk drivers is also created for decision-making purposes. Now at BVA, we are confident that no matter the scope and scale of your organization, Scenario Frontier is able to meet your stress testing needs at an appropriate customized level. We are pleased to offer a 1-month free trial to any interested organization who wants to gain a further understanding of how their firm will react to stress scenarios. Thanks. Paul?
Thank you, David. Thank you, David. Thank you, Suhail. So, ladies and gentlemen, you heard from our panelists the challenges of the new normal in a structured approach to improve business resilience and to address future disruptions. I believe BBA Scenario Frontier is a powerful tool for day-to-day strategic planning, permitting companies to identify and quantify risks and opportunities across a wide range of potential economic environments. The Scenario Frontier integrates budget, risk, macroeconomics variables for regulatory compliance and management action planning. I believe we are going into now the question and the Q&A. So please, if you have any questions, put in the question, the Q&A box. And I'll pass it over to Carolina.
Thank you, Paula. Thank you, Suhail. Thank you, David, for this amazing presentation here today. Yeah, like if you have any questions, and you can add either to the chat box or the Q&A box, and we'll make sure that we respond it accordingly.
How do you recommend to identify risk and develop course of actions?
Which risk, sorry?
It just says identify risks here and develop course of action, I guess, for the, the times we're going through.
Yeah, so.
Suhail, I think a better way we can answer that question is what approaches do we BVA take to create the scenarios used to measure the risks that we face in the future?
Oh, okay. Yeah, so that's a very interesting question. Essentially, the scenario planning, the key idea behind scenario planning is to develop forward-looking scenarios and not just focus on what happened in the past. Of course, past is always an indicator provides us with level of insight that we need to be able to replicate the experience. But the idea of scenario planning is really to determine forward-looking crisis or forward-looking growth opportunities, and then be able to prepare ourselves. Now, a starting point, as I said earlier, was to look at the risk drivers. And how do we look at these risk drivers? So essentially, we look at the core product or core offering of the organization. We discussed, for example, student enrollment at universities, and then which we would consider as from a technical perspective as a dependent variable. And then we try and search for some independent variable which would enhance the explanatory power with regards to the variability in student enrollment. So for that, we basically can start with a long list of some macroeconomic variables. It could be a function of, say, household income. It could be a function of preferences, with regards to one university or one school versus the other school, and things like that. And using a very sophisticated modeling toolkit that we have, we can then develop a relationship that would exist with dependent variable, i.e. in this case, student enrollment and the independent variables. Now that particular relationship essentially is expected to hold itself true for a certain period of time, but needs to be tested on a regular basis. And once that relationship is established, the next step would be then to collect the data, as we talked about the base case here. Now, base case data is essentially easily available, for most of the macroeconomic variables. This base case needs to have a forecast stretching over next 2 to 3 years. So, for example, if you're interested in learning about, say, 5-year mortgage rate, and what is it currently, and what it would be in, say, 2021 and 2022, there are some adequate forecasts available, and economists do work around that to be able to come up with those forecasts. Now, that is not something that we would do. We would have economists or different publications researched, polled around, interview the experts to be able to come up with the consensus forecast for the base case. Now, once the base case forecast is developed, the next step would be to look at what would be the downside case. And here we're referring to downside case as a stress case. Now, for that, BBA uses its sort of proprietary algorithm where we extrapolate the base case in both directions to be able to come up with the stress case. And using that stress case, then we can look at the downside financials, downside liquidity, and final piece would be what would be the black swan, which again is fairly technical and challenging, and it is perhaps outside the scope of this conversation, but there are different toolkits or different algorithms which can be used. One of them is principal component analysis that we can use to come up with that what could be the reverse or highly adverse scenarios which can have potentially devastating impact on the company's viability or a business's viability. Now, the key purpose behind developing that black swan or challenging the viability of the business is not really to be able to create what we would consider as a manifested scenario for, say, 2021 or 2022, but rather to create early warning signals that what would be the various hotspots which could become extremely disturbed or dislocated as a result of this particular black swan event. And that allows the business leaders, the risk managers, the chief operating officers to be able to develop a directional compass so that once those trigger levels are either approaching or are near, they can create what David just explained, a mitigating action, which we're calling an action plan, and bring that out so that from the perspective of raising additional capital, cutting the dividend payments, or safeguarding the liquidity, so those sort of those resources can be mobilized.
Thank you, Sahel. I think our chat's not working. There's something.
We have another question here from Maestro. So about ESG, in social environment perspective, considering for ESG, what will COVID increase how will COVID increase the risks involving corporations? And So is there anything you guys can explain a little bit further on, like your ESG
Yeah,
tools?
exactly. So ESG, from investors' perspective, is going to get increased prominence. Of course, ESG is again from the perspective of different organization has a variability, but what would become important in post-COVID-19 situation is how corporates are able to safeguard their employees and their full-time equivalents, their contractors. And I think that would have an additional dimension associated with that. And as David talked about, learnings from when it comes to working remotely, how those learnings can be basically practiced on a go-forward basis, what sort of process automations can be included, and how those could be safeguarded. So looking at three broader dimensions of ESG, which includes environment, social, and governance, each one of these dimension would have an increased level of scrutiny from investors' perspective. So companies need to be able to perhaps go back and recalibrate the impact of COVID-19 on ESG factors.
I got one question here, Suhail sent. Who are the best potential clients for scenario planning?
So yes, as I said earlier, looking at the history of scenario planning, it is of course relatively new from the corporate's perspective, from corporations' perspective, but the key theme of this presentation today was that what learnings existed from 2008 crisis and how they can be brought forward for the benefit of non-financial services organizations. So it is mandatory, it is a requirement almost for all financial institutions, be it credit unions or banks, asset managers, and so forth. But it has applications now across a wider spectrum of businesses, which includes corporations which are not engaged in financial services. So disruption, how does it get translated into macroeconomy, and how that disruption can then get translated into an organization's balance sheet, an organization's income statement, and cash flow positions. So that's really, in a nutshell, the outcome of scenario planning. And as I said, it's forward-looking, so we are not just looking at historical, we are looking at 2022, 23, and so forth.
Great, thank you. I know that we usually reach out to the Chief Financial Officer or the Chief Risk Officer, but I have a question here that says, are there any countries that can use this better than others?
Absolutely. So the key challenge in scenario planning is availability of data and consensus estimates with regards to the growth or decline from macroeconomic perspective. Of course, some countries where there is a significant focus on data and releases of economic forecast are relatively better placed and better positioned to be able to model scenario planning and make it an integral part of their risk culture, compared to those countries where limited or no data is available or the data is less reliable. So that is an unfortunate reality, but let me just say it that this should not discourage them from conducting scenario planning, because even though in the absence of data, consensus estimates can be reached, and I can hardly think of any country which is not covered by World Bank or IMF's macroeconomic coverage, and data relating to some key macroeconomic factors is not made available for those countries.
Okay. Thank you very much, Suhail, David. Carolina, any more questions?
No more questions here. So I would like to thank our panelists, Suhail, David, and Paola. Thank you so much for being here, for your availability to join us here today. I'd also like to thank our annual sponsors, Vale, Brookfield, Lundin Mining, and Votorantim Samar Cement for the support. We hope the information that we share here today was very fruitful and relevant for your business. And please keep engaging with BCCC. Please, you can download our app on our app store as well, BCC events, or follow us on social media at Braskem Chamber, or go to our website, www.braskemchamber.org, to be informed of our activities and events. As well, if you have any further questions, please do not hesitate to contact Hugh and David and Paula. Their information is here on the screen. They will be happy to hear from you. I wish you all a great weekend, great Mother's Day. Stay healthy, stay safe, stay home. Thank you so much, and we'll connect soon. Thank you.
Thanks so much.
Thank you.
Thank you, Carolina.